Hi everyone, and thanks for joining us today. This is Allison Dwyer with CQG, and it's my pleasure to introduce Jim Wyckoff. Jim has spent 30 years involved with the stock, financial, currency, and commodity markets, and has been a longtime CQG user. Today he will be covering market fundamentals, trading tactics, educational elements, and more. If you have any questions during the webinar, please enter them into the Q&A window off to the side, and we will answer them at the end of the presentation. Without further ado, I'll turn it over to Jim.
Thanks, Allison, and thanks everyone for attending my monthly markets outlook. I do go back a long way with CQG. In fact, I was just thinking here when Allison was speaking that my relationship with CQG goes back over 30 years when I was a markets reporter and editor with the FWN News Service. And we provided our news to CQG, and I developed a good relationship with them at that time, and we're reigniting it again here 30 years later, so that's kind of cool. So what we're going to do today is take a shorter term and longer term perspective on key futures markets. I'll discuss mostly technicals, but I will throw in a little bit of fundamental analysis, especially on a macro degree level. I started out working on the trading floors in Chicago and New York as a reporter, and one thing I learned quickly was that technical analysis was an important element in the success of the traders on the floor. And I quickly could perceive that, and I started studying technical analysis back then, and I'm still studying it to this day. And I would encourage anyone that doesn't know a lot about technical analysis just to at least maybe get a primer on what it's all about, because it is a valuable tool in making a trader more successful. Here's a disclaimer that I would encourage you all to read at some point, but we'll skip it right now. I always start out my webinars with daily charts, and then we're going to look at longer-term weekly charts. These are daily bar charts. I created them. Actually, some of the charts I had to update today because of active markets, but the weekly charts will follow. The weekly charts have support and resistance lines on them, and I would encourage you during the month to examine these support and resistance lines on the weekly charts, because if those resistance lines are approached or penetrated, it's a significant technical development that can either accelerate existing price trends, halt price trends, or reverse price trends. So we'll start out here with the daily chart on the U.S. dollar index. The U.S. dollar index is a basket of 6 major currencies weighted against the greenback, and the reason I start out with it is because it's an important outside market that influences many other markets on a daily basis. And as we see here on the daily chart, the dollar index has been trending lower all year long, and just last week hit a 2.5-year low. We've seen a little bit of short covering, a corrective bounce so far this week, but the bears remain in overall technical command of the dollar index. The fact that the dollar index has been trending lower is a bullish element for the raw commodity sector, even though many of the raw commodity markets are just languishing right now. Looking at the weekly chart for the U.S. dollar index, we can see that prices are also in a longer-term price downtrend. Really no early clues either on a short-term or longer-term basis to suggest that this downtrend in the dollar index is going to end at any point. Let's look at a daily chart for the euro currency futures. Price action has been in an uptrend for the past several weeks or even few months, and we've seen a little bit of profit-taking pressure in the euro currency this week, but the bulls still have the overall technical advantage in the euro currency. Now, it's my mission in my monthly webinars to have you take away at least one nugget or educational element that can help your own trading success. So if you think of questions, make sure you jot them down, and I'll try and get to them at the end of the webinar. Also, I feel like it's my mission to CQG to help you during the month also. So if you have a question, feel free to send me an email at jim@jimwyckoff.com. If you do have any questions on markets or educational tidbits or anything, I'd be happy to answer them, and I always do answer my email in a prompt fashion. Looking at the weekly chart for the euro currency futures, we can see the prices are in a longer-term price uptrend, just hit a 2+ year high recently. The bulls are in solid technical command. That means the path of least resistance for euro currency futures prices is going to remain sideways to higher until we get some kind of a technical development to suggest otherwise. Also, for you shorter-term traders that may just use intraday charts or daily charts, I would encourage you to look at these longer-term charts. History shows that markets, especially when they're trending, can gravitate toward historical highs or lows when they are trending. So if you look at a weekly or a monthly chart, you can look at some of those highs and lows experienced in recent history, and if the market's trending, it could be gravitating toward that next historical high or historical low. Let's take a look at the December E-mini contract daily chart, just updated today. We can see the prices today hit a new all-time record high. We did see a lot of choppy price action the last half of the summer, and there were some worries heading into the historically turbulent months of September and October that maybe the stock indexes were running out of gas. Many of the stock market downturns that were serious have occurred during the months of September and October. However, just this week we've pushed to new highs. Now, what's going to be important for the E-minis stock indexes this week is if we can close this week at or near the weekly highs, that's going to be a significantly bullish development to suggest a fresh leg up in prices. If we see some profit-taking pressure the next couple of days, and if we see prices close well off the highs that we've just set today by Friday, then that's going to be a clue that the bulls may be exhausted and may see some maybe more sideways and choppy trading. Keep in mind, we are still in these turbulent months of September and October, not even halfway through September yet, so there still could be some fireworks and even downside fireworks in the stock indexes. Weekly chart for the S&P 500 nearby futures shows prices in a long-term uptrend. No early technical clues on a longer-term basis to suggest that the price uptrend is going to end anytime soon. The one thing I would point out is looking at this weekly chart, we've been trending prices higher in the S&Ps for over a year and a half now, and we really haven't seen a serious downside price correction on the weekly chart this year. This is a market that's very long in the tooth from a bullish perspective, and it's very likely that most of the price gains have already occurred during this bull market move. So be cautious about being long for an extended period of time in a market that's arguably well overextended on the upside. Looking at the Nasdaq futures, much the same situation. Yesterday on Tuesday, we did score a contract and record high close in the December Nasdaq futures, so the bulls are in firm technical command here too amid some recent choppy trading. Weekly chart of the Nasdaq also shows prices in a longer-term price uptrend, scored a new intraday high about 2 weeks ago, so the bulls are in firm chart command here in this stock index also. Let's take a look at the Treasury bond futures market. We're going to start out with the December contract here. Prices last week scored a new contract high. We've seen some flight to quality buying here the past few weeks due to some geopolitical concerns with the U.S. and North Korea in a stare down presently. But we've seen some serious profit-taking pressure this week in the bonds, and if we see a bearish weekly low close on Friday or close to it, that's going to be a near-term technical signal that this market has put in a near-term top. So the price action in the bond market the next couple of days is going to be extra important. Weekly chart on U.S. T-bonds also shows the market in a price uptrend. Just recently hit a multi-month high. The bulls are in firm command on a longer-term basis also. Much the same situation for 10-year Treasury note futures. Prices last week hit a contract high. Seen some heavy profit-taking pressure this week. Bulls need to step up and show some fresh power soon in the notes futures to keep this near-term price uptrend in place. Again, a bearish weekly low close on Friday would be a technical clue that the market has put in a near-term top. Weekly chart on U.S. Treasury note futures shows prices also in an uptrend. New multi-month high scored just recently. Bulls have the longer-term technical advantage. Now, when I'm looking at these daily and weekly charts with you, when I talk about a short-term technical situation, that usually involves a daily chart. When I talk about a longer-term technical development, that either involves a weekly or a monthly chart. Now, in this webinar, the longer-term charts are all weekly charts, but in some webinars, I like to throw in monthly charts to give an even longer-term perspective on markets. We're going to take a look at the weekly charts only for the currency futures traded at the IMM in Chicago, starting out with the Australian dollar. We can see here that the Aussie dollar prices are in a choppy uptrend, and the bulls have the longer-term technical advantage to suggest still more upside price action in the Aussie dollar. Weekly chart of the British pound futures shows prices, in fact, just this week, prices did poke, I believe, to a new at least 12-month high, and the bulls have the longer-term chart advantage here amid a fledgling price uptrend on the weekly chart. Canadian dollar futures also shows an accelerating price uptrend in place. Just broke out to a new 2-year high here last week. The Canadian dollar bulls are in firm command. More upside price action is likely. Weekly chart on the Japanese yen futures also shows a choppy price uptrend in place, and we just hit a new multi-month high recently. So all these currency futures that are rallying and hitting new highs, that's been bad news for the U.S. dollar index that recently hit a 2.5-year low. This is an important chart I want to point out to you. This is the weekly chart for the Goldman Sachs Commodity Index. The GSCI is a basket of several major raw commodity futures prices rolled into one composite index. And what we've seen here recently in the GSCI is just sideways and choppy trading. We're going to look at a crude oil chart here just shortly, but the crude oil market looks the same. Crude oil is arguably the leader of the raw commodity sector, and the fact that crude oil has been languishing in a choppy and sideways fashion has led to many other commodity markets languishing in choppy and sideways price ranges or even trending lower. For the raw commodity market bulls to really get excited and maybe see some solid price uptrends like we saw a few years ago when commodities were hitting record highs, we're going to have to first see the GSCI push above resistance at the highs seen earlier this year as depicted by that blue line on the weekly chart. So if you do trade commodities, I would encourage you to keep an eye on this Goldman Sachs Commodity Index, because that raw commodities tend to trend in the same directions, led by crude oil. Remember that I mentioned the dollar index was a key outside market. The other key outside market that I follow closely is crude oil prices on a daily basis. So right now, the weekly chart for the Goldman Sachs Commodity Index is suggesting more of the same, sideways and choppy trading action. From a fundamental perspective, recent economic data worldwide that has been tepid at best for showing economic growth has led to ideas that the central banks of the world, especially the Federal Reserve and the European Central Bank, are probably not going to embark upon tightening their monetary policies anytime soon, especially the Federal Reserve after these two recent hurricanes are probably going to shave a little bit off of our GDP. What that means for the commodity markets is interest rates remaining low, inflation remaining low, and that argues for squelching bull markets in many commodities. Looking at the daily chart for October Nymex crude oil, we can see this choppy price action that's been in place really for several weeks, and it could be argued all summer long. Let's take a look at the weekly chart, and I can better determine or depict that. The weekly chart for crude oil futures shows prices just really for the past year and a half have been trading in a range between $42 a barrel and $55 a barrel. It's my bias that we're probably not going to break out of this sideways trading range anytime soon. As an aside, when I was a reporter back in the 1980s, a cub reporter, the crude oil market was much more susceptible to geopolitical events. The crude oil market still does react to geopolitical events nowadays, but given the big increase in U.S. shale production and the U.S. becoming much less reliant upon imported crude oil prices from the Middle East, that has taken a lot of the so-called war premium out of the price of a barrel of crude oil, and also reduced volatility. That's also spilled over into some of the other raw commodity markets. So the low volatility we've seen in the crude oil market recently has spilled over into the other raw commodities. Again, crude oil is an important outside market. Keep a close eye on that crude oil market on a daily basis. Big moves in the crude oil market, either to the upside or the downside, are probably going to impact other raw commodity markets on that day also. Natural gas futures market trading sideways and choppy at lower price levels, as seen here on the daily chart. My bias is that we probably don't have a lot of downside left in the natural gas market with prices below $3. Weekly chart on natural gas futures shows choppy price action the past several weeks. It can be argued that, let me just see if I can draw a downtrend line. It can be argued that the natural gas market remains in a price downtrend on this longer term weekly chart. All right, let's take a look at the metals market, starting out with gold. Probably more interest in the gold market here recently as prices last week hit a 12-month high. Gold prices are in a near-term uptrend. The technicals in the gold market are the most bullish they've been on a near-term basis in quite some time. Weekly chart for gold also has turned more bullish as we see that prices have pushed to a 12-month high. From a fundamental perspective, we've got geopolitical tensions, namely the U.S. and North Korea, that are driving safe haven demand for the gold market. We've got some stiff overhead resistance on a longer-term basis at the 2016 high of 1378, as seen here on the chart. If we push gold prices above 1378, you're going to see a very quick challenge of psychological resistance at 1400. And if we can push prices above 1400, I think you're going to see a quick move to 1500, because there's a lot of dead airspace on the chart here between 1400 and 1500. So the gold bulls are sitting in a good posture right now, despite some profit taking that we've seen here just recently. Much the same situation for the silver market. Prices are in an uptrend on the daily chart. New multi-month high scored in silver just recently. Weekly chart on silver shows a choppy and sideways trading range. We are moving up into the upper boundary of the trading range, which either suggests that stiff resistance at the 1865 level is going to halt that rally, or if we break above it, the rally will accelerate. So we're at an inflection point here probably in the next couple of weeks for the silver futures markets. However, if the gold market can continue to rally, it's my bias that silver is going to be a follower. Copper market, prices had been trending higher, pushed above $3 a pound last week. We've seen some heavy profit-taking pressure this week. If we close the copper futures market on Friday at or near the weekly low close, then that's going to be a near-term technical signal that this market has put in a near-term top. So the bulls need to step up and show some fresh power soon in the copper market to avoid some serious technical damage that would suggest a near-term top is in place. Looking at the weekly chart for nearby copper futures, we can see the prices spurted higher in late 2016, spent much of the first half of this year consolidating, trading sideways, and just the past few weeks as prices have spurted higher to keep a longer-term price uptrend in place. Next upside objective is longer-term resistance at 327.50. Let's take a look at the international foods market, starting out with sugar futures. Choppy trading the past couple of weeks in sugar, but prices have been trending higher from the August low. My bias is that we're probably going to see more choppy and sideways price action in the sugar market. We do have some near-term resistance just above 15 cents. If we can push prices above that level, then I think you can sustain a price uptrend. Weekly chart on sugar shows choppy price action the past few weeks. And right now we're right in the middle of a trading range that I have defined by the support and resistance lines seen on the weekly chart. I'm giving the overall longer-term technical advantage to the bears in the sugar futures market. By the way, I'm a firm believer in chart patterns. I've read books that were written, you know, even 100 years ago that defined basic chart patterns. And I would encourage you, if you're interested in technical analysis, to read some books. John J. Murphy has an excellent book called Technical Analysis of the Futures Markets. It's a textbook type read, but he points out several chart patterns that you can define yourself with a little practice. But on this weekly sugar futures chart, I can see grab my pencil here, a bearish head and shoulders top reversal pattern that's kind of a classic looking one that formed during much of 2016 that portended the big downturn that we saw the last half of 2016 and into 2017. So these basic chart patterns like the head and shoulders reversal are important, and if you can identify them early, it can give you clues on future price action. Take a look at the coffee market. Big spurt higher this week in the coffee market, and we can see here on the daily chart that the coffee market had a bullish rounding bottom reversal pattern form over the past few weeks, and then we saw a big upside push. So again, around early September, one might have surmised that we were developing this rounding bottom reversal pattern, and might have been an early clue that prices were going to spurt higher in the coffee market. Weekly chart on coffee futures, just kind of choppy price action, volatile, a little more volatile here on a weekly degree basis, but right in the middle of a trading range. Cocoa market on a daily chart shows prices have been trending higher in a very choppy fashion since the August lows. I would still give the bears well, I'd say this daily chart's kind of neutral, so the bulls and bears are probably going to continue to struggle for near-term technical control here in the near term in the cocoa market. Weekly chart on cocoa futures, choppy price action, again right in the middle of a trading range on a longer degree basis, but I'd give the bears the longer-term technical advantage in the cocoa market just based upon the fact that we are well into the lower half of the longer-term trading range as seen here on the weekly chart. It can be argued, however, that with prices near the recent historical lows, there may not be much downside left in the cocoa market, and at some point this sideways price action that we've seen the past few weeks could be basing that eventually kicks off a longer-term price uptrend. Cotton market, boy, the cotton market has really been volatile here the past week or so with the hurricanes that struck the U.S. Last week there were ideas that there was going to be major damage to the cotton crop in the southeastern U.S. The Florida hurricane anyway was not as serious or severe as expected last week, and so we saw prices shoot higher last week, and they've dropped just as sharply this week. So the cotton market is back about where it started before all the hurricane worries hit the market, and I do give the overall near-term technical advantage in the cotton market to the bears given this week's downside price action. Weekly chart on cotton also shows that big spurt higher we saw the past couple of weeks, then we've dropped back sharply this week. I'm giving a neutral rating to this longer-term chart on the cotton futures market. Going to have to push prices either above the resistance line or below the support line to really likely kick off a serious longer-term price trend in this market. Orange juice market, kind of the same thing. The southeastern citrus crop was in peril last week, according to traders' perceptions. The price did shoot higher. Prices have backed off a little bit this week. However, I still think the marketplace senses that there's some damage that occurred with the high winds in Florida that will keep the orange juice market supported here in the near term. Also, in the months of October and November, December, the speculative long traders tend to load up on the long side of the OJ market in anticipation of the potential for a freeze damage to the orange crop occurring sometime this winter. Weekly chart on orange juice shows that big rare gap higher trade with that weather-related scare. So the bulls have gained some longer-term technical momentum here on the weekly chart for OJ, suggesting there may be more upside price potential coming. Lumber market prices have shot higher the past couple of weeks, again based upon the notions of increased demand for lumber in the southern U.S. from the major hurricanes that struck. Weekly chart on lumber futures also shows a choppy price uptrend that's been in place for 2 years. Resistance at the 2017 high of 414.60. Let's take a look at the livestock market, starting out with the cattle. December live cattle futures prices looks like they bottomed out in August and starting to trend higher in a choppy fashion. Just this week we've scored a new 4-week high in the cattle market. That's an early clue that this market has put in a bottom and could continue to trend at least sideways, if not sideways to higher here in the coming few weeks. Weekly chart on live cattle futures still shows a steep longer-term price downtrend in place. This week's price action, as denoted by the latest bar that you see, does show a rebound, but from a longer-term perspective, you're going to have to push prices back above resistance at 118 and change in order to really get a longer-term price uptrend uncorked. Hog market. Bears in firm command here. We did see a decent rally in early September, but that rally has given way to selling pressure. If we drop prices below the August low, there's probably another leg down left in the hog futures market. Weekly chart on lean hogs also shows some downside price action recently. I tend not to pay too much attention to the weekly chart on hogs. The different months that trade hog futures are so varying in prices from month to month from the contract month that it really makes for a sloppy weekly chart, so I tend not to spend a whole lot of time on the weekly chart for hogs. Okay, lastly, we're going to take a look at the grains. December corn futures here. We saw a bearish USDA report on Tuesday that sunk the corn market. We did stabilize prices today. We did not take out the August contract low in December corn. My bias is that we have indeed put in a harvest low in the corn market, even though harvest has not started yet. Remember that futures traders are front runners. They tend to factor in expected developments well before they occur. So in other words, traders have been expecting a big U.S. crop to be harvested. My bias is that we did put in a harvest low a few weeks ago. There's certainly a possibility that we could poke to a new contract low in December corn, but I don't see strong downside potential with December corn prices trading around $3.50. Weekly chart on corn also shows a steep downdraft that's been in place since the summertime weather market related highs. We have seen a big bounce on a weekly degree basis off of the low scored a couple weeks ago. That bounce off the low that we saw a couple of weeks ago suggests that the bears became exhausted and prices just put in a spike low. But anyway, the bulls are going to have to step up and show some fresh power soon on a near-term basis to suggest that this corn market can start a near-term price uptrend. November soybeans, we had a bearish USDA report on Tuesday, but the market posted a nice rebound on Wednesday. So again, also it's likely that in August the soybean market put in a seasonal low, and prices are likely to work sideways and maybe sideways to higher here in the near term. Weekly chart on soybean futures shows choppy price action at lower levels. Another good reason to look at a weekly chart is you can examine this weekly chart on soybean futures and see that lows in 2014, 2015, and 2016 are not that far below where price action was in a few weeks ago to set our yearly low. So those are some strong support areas just below the market. To put it another way, the soybean market likely has much more upside price potential with prices trading around $9.50 than it has downside potential. Looking at the soft red winter wheat market, prices are trying to put in a low, trying to establish some sideways trading. If the corn and soybean markets have indeed put in seasonal lows, then it's likely the wheat market has too. The wheat market is going to be a follower of the corn and soybean markets probably until the end of the year. Weekly chart on wheat also shows that prices have spiked down from the summertime weather market highs. Note these support and resistance lines here on the weekly chart for wheat. And finally, we're going to look at the oats market. Prices in a downtrend in the oats, and the bears have the near-term technical advantage. Weekly chart on oats also shows prices have backed well down from the summertime high, and we drop below support at $2.13 in the oats market. You're probably going to see a challenge of $2 soon. Okay, that concludes my presentation on the short-term and long-term markets outlook. I'd be happy to take questions if you have any. I'm going to revert back to my PowerPoint presentation so I can look at some questions that may be coming in. And if you see any questions, Allison, point them out to me, and I'd be happy to.
Of course. Let's wait a few minutes,
sure.
See if anything comes through.
Okay. Here's a question from Steve. Where is this Goldman Sachs Commodity Index graph available? All my charts that I created today were created with CQG, and I suspect that and the Goldman Sachs, I think your CQG customer service rep would know the symbol for that Goldman Sachs chart, but it is available on CQG, and I would encourage you to just have that graph handy to look at on an occasional basis, because it does give you a good feel for what how the raw commodity sector is trending. Oh, here's one. Can you discuss trading tactics, please, regarding your analysis? Yeah, that's a good question. My trading strategies and analysis are based upon trend lines and price trend and basic chart patterns. By that I mean being able to look at a chart and identify price trends by looking at so-called reaction highs and reaction lows, or by trying to decipher chart patterns. Those are what I call my primary trading and analytical indicators. My secondary trading tools and analytical tools are computer-generated, like moving averages, slow stochastics. When I got into this business over 30 years ago, the advent analysis and charts was just in its infancy and really not even available to most. In fact, I got charts that came in the mail on a weekly basis that I updated by hand every day, and that gave me a good grounding on looking at charts and being able to determine basic chart patterns just by eyesight. And I think anybody that's interested in technical analysis can do the same. And by reading that book I mentioned by John J. Murphy, that basic textbook on identifying chart patterns and such, would be a good way to begin anyway. Here's a question. Is it unusual for gold to leave a gap on the chart given the extended trading day? Yeah, it is unusual given the and also depending on the liquidity of the contract month. But for a nearby futures contract to leave a price gap given the nearly 24-hour trading that we've seen, it is unusual. Now, depending on the time frame of your chart. Now, if you have an intraday chart, let's say a 5-minute bar chart, you're probably going to see gaps more often than you would on a weekly chart. But back before the advent of electronic trading, you saw a lot more gaps on charts than you see nowadays. That's a good question. Okay, another good question that just came in. How do you incorporate fundamental analysis into your technical chart reading for trading setups? Let me give you an example. I base most of my decisions upon chart patterns and technical analysis. The reason is that it can be argued that when you look at a price chart, that price chart and those bars, those daily bars or those intraday bars, have incorporated all of the fundamental analysis and situations and expected situations that are known to that market at that given time. The price action has reflected that and incorporated that. However, if I'm a technical trader on a Friday morning on the first Friday of the month, I know that there's an unemployment report coming out, a U.S. unemployment report coming out at 7:30 Chicago time that's likely going to move the financial markets. And if I'm a purely technical trader and I ignore fundamentals, you might ignore the fact that at 7:31 a.m. on a Friday morning, the market's going to see some gyrations. So you can't ignore fundamentals in a market. I think a mistake that can be made is to try and study all the supply and demand fundamentals in a market. I think you'd spend all your time doing that, and even if you did do that, the marketplace is going to know it at the same time or even before you know it. So that's why looking at charts and trying to determine chart patterns and price history and human nature is a good way to take a look at trading markets. Allison, I don't see any questions that are coming in, so we might have wrapped it up.
Say that. Yeah. Okay, well, thank you everyone for joining us today, and thank you, Jim, for presenting. If you missed anything during today's webinar, you can view a recording on CQG's YouTube page, which will go up shortly. And Jim, I don't know if you wanted to give out your email again,
Yes,
in case any other questions come through.
Yeah, it's jim@jimwyckoff.com, and you can send me an email at any time during the month until the next webinar that I do for CQG, and I'd be happy to answer any questions you have.
All right, sounds great. Thanks, everyone.
Thanks. Bye-bye.